place of residence. So I remember. So when we talk about place of residence, we are talking about place. We mentioned that place of residence in relation to personal income tax, because the relevant tax authority for personal income tax is the state internal revenue service of the place of residence of the individual taxpayers. So, and we now said, what is place of residence? In relation to an individual, place of residence means a place available for his domestic use in Nigeria on a relevant days. It does not include any rest house, any hotel, or any other place that are used for temporary lodging, unless no permanent place is available for use on that day. The topic is under personal income tax. We are in personal income tax. Because personal income tax, for us to determine the tax authority that will collect personal income tax, personal income tax is mostly collected by State Internal Revenue Service. But the State Internal Revenue Service of the place of residence where that taxpayer resides. Take, for instance, I reside in Ogun State. I work in Lagos State. So, who am I going to remit my personal income tax to? I will remit it to Ogun State Internal Revenue Service. Despite every day, I always go to Lagos State to go and work. I will come back to Ogun State. So, personal income tax is based on residential rule, where you reside, not on income rule, not on where you are deriving the income. Unlike company income tax, is based on income rule. So, under personal income tax, we have two types of place of residence. We have single residence. Single residence means a situation whereby the taxpayer have one place of residence. He has one permanent place of residence. He's just staying in one state. He does not stay in two states. But in the case of dual residence simply means a situation whereby an individual have more than one permanent place of residence. It happens. Some people, they will have house in Lagos State, they will have in Ogun State. Maybe they are from, the person is from Oyo State. You have another one in Oyo State, and maybe the person is a polygamous somebody. So he may have a wife in different location, and every month he will be going to those different states. That person is a dual resident, person that resides in more than one state in a relevant year of assessment. Is different from itinerant worker. So this person, this dual resident person, he has more than one permanent place of residence. Maybe he has like 2 wives or 3 wives. So they are in different states. That person is a dual resident. So when an individual is a dual resident, what do we need to do? When an individual is a dual resident, what we need to do is for us to determine the principal place of residence. When an individual is a dual resident, we need to determine the principal what? Place of residence. That means out of the 3 places, which one is the, out of the 3 permanent places that that person is staying, which one is the main place of residence of the person? In the case of employment income, principal place of residence will be the place that is nearest to your place of work. Assuming that person is earning only on employment income, the principal place of residence will be the place that is nearest to his or her place of work. And in case of investment income, The principal place of residence will be the place that is nearest to the location of the investment. So that is what we have on principal place of residence. Now, the next area we need to look at now is registration process of an employee and employer with the relevant tax authority for the purpose of personal pay as you earn. Pay as you earn means personal income tax deducted from employee salaries. Personal income tax deducted from employee salary is called pay as you earn. The personal income tax deducted by the employer from the employee salary is called pay as you earn. Under Section 4 of NTAA, there are registration process that must be followed for a company to register their employees under personal income tax, for a company to register their staff in order to obtain taxpayer identification number. There are registration process to follow. So we look at that. First thing is, an employer shall register with the relevant tax authority for the purpose of deducting income tax from his employer, from his employees. So that means a company too must register with the State Internal Revenue Service that they want to be deducting income tax from the employees' salaries. Another one is deduction of tax from that employee's salary. If employer fail to deduct tax from the employee's salary, that employer will pay a penalty of what? 50,000 in the first month and 50,000 for every subsequent month in which the failure continues. That means failure to deduct personal income tax every month will attract an administrative penalty of 50,000 for the first month and 50,000 for subsequent months in which the failure continues. Recording of deduction. If an employee deducts the personal income tax from the employee salary, if an employer deducts personal income tax from the employee salary, what are the information that the employer will keep if the employer wants to make payment of that personal income tax? That means if an employer wants to file personal income tax, that monthly personal income tax deducted by employer from the employee personal salaries. If an employer wants to make the payment, what are the information that the employer will provide? Month of the payments, amount of the emolument, contribution by the employees to the approved pension fund, cumulative net emolument in relation to the date, cumulative free emolument in relation to that date. Cumulative taxable emolument in relation to that date, and correspondence correspondence cumulative task. So these are the information that the employer will provide while deducting the tax of employees on a monthly basis. So we are still going to look at all these while we start solving questions, and we are still going to look at them under tax return that we are going to do. So the major area that is so important for us in this topic is, let's look at format for computation of personal income tax. After we look at the format, we now be explaining them one by one. So we are still going to explain all these theoretical aspects, but for us to look at the format, from the format, we will now go back to the explanation one by one. Because without the format, we cannot do the proper explanation. If we want to compute personal income tax based on the new tax law, we have your personal income tax computation. The income under the personal income tax will be divided into two: earned income and unearned income. Earned income and unearned income. Earned income and unearned income. For the earned income, what do we have under the earned income? We have basic salary. We have entertainment allowance, leave allowance, staff allowance, transport allowance, housing allowance. We have gratuity, benefit in kind. They are under earned income. Trading income too, they are under earned income. Professional fee income, they are under earned income. Part-time income, they are under earned income. Chargeable gain from disposal of chargeable asset, that is capital gain, they are under earned income. So your format for computation of personal income tax, you divide it into two. Earned income first. You now have unearned income second. Earned income first, and the second is unearned income. What do we have under the unearned income? Unearned income: dividend gross, rent gross, royalty gross, interest gross. They are the unearned income. Earned income: we have the basic salary, like I explained, housing allowance, transport allowance, leave allowance, staff bonus, benefit in kind. So at the end of the day, if you plus your earned income plus your unearned income together, it will give you what? Gross income. Can we all see the gross income? Gross income. From the gross income, you will less frank investment income. Frank investment income means those income that are suffered tax at source, and the tax deducted at source is a final tax. Examples of frank investment income. What is the examples of frank investment income?
I can
Dividend
say treasury
gross.
bill.
Dividend gross. If a company pay dividend to shareholder, they will have deduct withholding tax on that dividend. That withholding tax deducted on that dividend is a final tax. No tax authority will come and ask the shareholder to come and pay another tax on that dividend again. So how do we treat the dividend? Dividend, we classify it as unearned income. We now come and remove it again. You can see under the unearned income, dividend is stated there. The law say, though it's not subjected to tax, treat it as part of your unearned income. After you get your gross income, come and remove it again as frank investment income. Assuming we use 100,000 for this dividend under the unearned income, is the same 100,000 we are going to remove as dividend under frank investment income. So that means it doesn't have any effect. So by removing frank investment income from gross income, you will get net gross income. When you get net gross income, you will now less tax exempt. This tax exempt under the new tax law, under NTA, is called eligible, is now called eligible deduction. If you look at the new tax law, you may not see tax exempt. They call them eligible deduction. What are the tax exempt we have? National Housing Fund, pension, NHIS or HMO. Gratuity, interest on mortgage loan, life assurance policy, rent allowance, rent relief allowance. All these, they are the tax exempt or eligible deduction. Let me start from number one. National Housing Fund. Every month, employer deduct National Housing Fund from employee salary. The rate deducted by the employer is 2.5% of basic salary. So that amount will serve as a tax deduction. That means it tax exempt. It will be used to reduce income of the employees so that the tax that the employee will pay will reduce. The whole essence of all these tax exempt is to reduce your income so that at the end of the day, your tax liability will reduce as a taxpayer under personal income tax. So for the NHF, the examiner will give us the NHF amount. You don't need to find 2.5% of basic salary if the examiner gives us the amount. But if the examiner did not give us the amount, and the examiner said in the question that the company deducts National Housing Fund from the employee salary, that means we have to calculate it by ourselves by looking for 2.5% of basic salary. Are we making sense? Pension contribution. There is employer pension contribution, there is employee pension contribution. The one that is used as tax exempt is the one contributed by the employee. That means the one that they deduct from the employee salary, which is 8% of BHT. What is BHT?
Basic housing and
transport allowance.
So 8% of sum of basic housing and transport allowance is what is the pension contribution that we use as eligible deduction. However, employee can contribute more than 8%. The law say minimum of 8%. If the employee contributes more than 8%, we can deduct it too. Say, for instance, but employee must not contribute more than 20% as voluntary pension contribution under the tax law. If employee contribute more than 20%, what will we deduct under eligible deduction or under the tax exempt is only 20%. But the law say minimum of 8%. But we are not after this percentage. In an exam under the tax, under personal income tax, if they want to test a question on pension contribution, the examiner will give us the amount. We just use the amount. But if the examiner did not give us the amount, we have to find it by ourselves by looking at 8% of BHT. NHIS, National Housing, National Health Insurance Scheme, or when employee deducts HMO contribution from the employer salary, that amount is also a tax exempt. Gratuities too. This gratuity, we have used it as part of earned income. Under earned income, the amount used under the earned income here, we also serve as tax exempt. The amount used under the earned income, we also serve as tax exempt. Some people in another situation, some people will not recognize gratuity as earned income. Once you don't recognize it as earned income, you don't need to use it as tax exempt. What is your question, Evelyn?
Sir, please, I'm sorry. I feel the pace is too high, and I want to beg. Can we get the full material for your topics for your class, please? The full material. I can't find it in the group,
Okay,
so I don't even know where we are.
Okay, just hold on.
It's been dropping material every week.
I'm dropping the material. This is personal income tax. I'm still working on the material based on the new tax law. Do you understand? I will drop the material tomorrow. I don't want to drop this material now. I delete it again. That is the reason why I'm doing it like this. I will drop the material. Do we have any outstanding material we are yet to drop? Except this. So please, let's take it. I will drop the material. Secondly, on the issue of fact, so that one is well noted. Please, so I will take it easy. No problem.
Thank you.
Yes. So, do we understand the treatment of gratuity? Hello?
No.
Do we understand the treatment of gratuity? I said
yes, sir.
There are two ways to treat gratuity. You can use it as part of your earned income and come and use it as part of your eligible deduction, which is your tax exempt again. Another way is for you to ignore the gratuity. You will not add it as your earned income. You will not come and use it again as part of your tax exempt. Do we understand that? Okay, please. I've seen a lot of people are raising up hand. Okay, one after the other. The first person, Gloria.
Oh, good morning, sir. Yes,
Good
I have
morning.
a question concerning the NHI, no, the 8% of DHF or something. You said the maximum
Pension
is 20%.
contribution.
Yes, pension. Yeah. You said the maximum is 20%. So, if,
Yes.
say for instance, the employee contributes 17% voluntary, which percentage are we going to use to calculate if examiner does not give us the amount?
employee contributes 17% voluntarily. You know, compulsory contribution is 8%. Out of the 20%, compulsory contribution is what? 8%. The maximum voluntary contribution that tax allow is 12%. 8 plus 12, making how much? 20%. Do we understand? Hello?
Yes. Yes.
So, if he contributes more than 20%, there is no law that said he should not contribute more than that as part of his voluntary contribution. But what the law allows is maximum of 20%. That maximum of 20% means mandatory contribution of 8% plus voluntary contribution of 12%, making it 20%. Do we understand that?
Mandatory of
Yes.
8%, voluntary of 20%.
Yes,
The
I
rule of
understand. I'm
12%,
saying that
which
from that
In an
17%.
exam, examiner will give us the amounts. Examiner, they will give us the amounts. They will not say we should go and find it by ourselves. They will give us the amounts. But I'm just explaining what is on ground, that in some cases, if the examiner did not give us. But if the even if the examiner did not give us, they will just ask us, the company pay pension contribution for their staff. The company deduct pension contribution from their staff salary. They will not tell us the percentage. It is now mandatory for us to use the minimum rate of what? 8%, since they did not give us the percentage of that contribution. But if the examiner give us that, the company, they deduct a contribution of pension from their staff salary, 25%. They say they deduct 25%. How many percent are you going to use as eligible deduction here?
20.
20. That is what I'm saying. So that is what I'm saying. Irabo, what is your question?
Good morning, sir.
Good morning.
Yeah. So when you were talking about gratuities, you mentioned that we can actually add it as our earned income. Then it's allowed to be added as our earned income. Then you come and list it as part of the eligible deduction, or
Yes.
we can ignore it, right?
Yes.
Okay. So can we say that the same process applies to dividend also? Can we
It does
just
not
ignore
apply to dividend. You have to show dividend as your income and treat it as frank investment income.
Okay, so you have to, okay.
Yes,
All right, no
that
problem.
one is compulsory. Okay. So can we proceed? I think all your questions have been addressed. So
Yes, sir.
interest on mortgage loan, if you collect a mortgage loan to build a house, or you collect a mortgage loan to buy a property, an estate, that interest you pay every year is part of eligible deduction or tax exempt. Life assurance policy too. Group life assurance policy. Companies pay group life assurance policy for their staff. They can deduct the premium from the staff salary. Do you understand? Or the company pay the premium by themselves. That group life assurance policy, the annual premium pay, irrespective of the individual staff, is an eligible deduction. It's a tax exempt. Another tax exempt introduced by the new tax law is called rent relief allowance. This one was introduced by the new tax law by NTA 2025. Rent what? Relief allowance. This one is only applicable to those who normally stay in a rented apartment. It's applicable to those who stay in what? A rented what? Apartment. It does not applicable to those who own a building. No. If you are living in your own house, you can't claim rent relief allowance. It is only when you are living in a rented apartment. And the law say that rent relief allowance is 20% of actual rent paid. Assuming your annual rent you pay your landlord is 2 million, 20% of 2 million is the rent relief allowance. Subject to maximum of 500,000. Subject to what? Maximum of 500,000. What that question is saying is, if you calculate 20% of your rent, actual rent, if it is more than 500,000, the maximum you can claim is what? 500,000. Let me give an example. I paid a rent of 3 million annually. 20% of 3 million. What is 20% of 3 million?
600,000.
600,000. If I want to claim a rent relief allowance, how much am I going to claim?
500,000.
500.
500. What if I paid a rent of 1 million naira? 20% of 1 million naira.
200.
200. So if I want to claim a rent relief allowance, how much am I going to claim?
200.
200.
200. Do we understand it? My explanation is clear. Please. The rent relief allowance is 20% of the actual rent paid. 20% of what? Actual rent paid. Subject to maximum of 500,000. That is how the law states it. What that statement means is that if somebody paid a rent of 3 million, 20% of 3 million is 600. You cannot claim 600. You either claim 500. Maximum of 500 on that 600. But if your 20% of that your annual rent paid is less than 500, you will claim the actual amount. Take for instance, my annual rent I pay to my landlord every year is 1 million naira. 20% of 1 million naira, 200. Is 200 I will claim. I can't claim 500. So in the case of rent relief allowance, tax authority, they have published some notification guideline on condition for claiming this rent relief allowance. One of the conditions is for you to claim rent relief allowance, you must provide receipt given to you by your landlord, your rent receipt. Another condition, you must provide evidence of transfer made to your landlord account. In some cases, some people even say you need to provide your rent agreement. You cannot just claim this rent relief allowance. There are conditions attached to it. You need to provide your rent receipt, evidence of transfer to your landlord, your rent agreement. You must provide that. So at the end of the day, you add all the eligible deduction or all the tax exempt, you add them together. When you add them together, you less them from the net gross income to get your chargeable what? Income. You less your tax exempt from the net gross income to get your chargeable income. This chargeable income is what you will pay tax on. Mind you, if your net gross income is less than minimum wage, annual minimum wage, you will not pay personal income tax. If your net gross income is annual minimum wage or below, you will not pay personal income tax. You will be exempted from payment of personal income tax. What is the annual minimum wage amount? What is the annual minimum wage amount?
800,000 annually.
Okay,
840,000. 800 and what? 40,000. 840,000. 70 times 12. It will
840.
give you what?
840,000.
In practical,
So,
yeah.
what I'm saying in essence is, if this one in color green, net gross income, if it is less than 840, you just write a note. You will not claim all these tax exempt again. Just write a note that, this company, this individual, Mr. Tunde, will be exempted from personal income tax because he's earning minimum wage or below. Any employee, any person that earn minimum wage or below, they are exempted from personal income tax.
So, sir, a question, sir.
Okay.
Does it mean if by the time we get to this net gross income and our calculation ends up being 840 or less than 840, there won't be any need to go further in doing all these charges and all those things. Just that note will suffice for exam purpose.
Yes, there won't be any need for go further. But if you go further, you have to write too that the company will be exempted from personal income tax. The taxpayer, the individual, will be exempted from personal income tax because the net gross income is already less than minimum wage. You should be careful. Net gross income is what I'm saying. I'm not saying taxable income.
Yes, sir. All right.
Do you understand?
Sir. Yes, sir.
So when you get your taxable income, you will now compute your tax liability. How do I compute my tax liability? First 800,000 is going to be taxed at what percent? 0%. Second, next 2.2 million is going to be taxed at what? 15%. Another 9 million is going to be taxed at what? 18%. Another 13 million is going to be taxed as what? 21%. Why another 25 million is going to be taxed at what? 23%. If we add from 800 plus 2.2 plus 9 million plus 13 million, if we add them together, it will give you 25 million. That one is taxed at what? 23%. If we add 25 million, 13 million, 9 million, 2.2, 800, it will give you 50 million. Anybody earning above 50 million annually, they will be taxed at what percentage? 25%. Any income above 50 million, they will be taxed at 25%. So when you get your tax liability, your personal income tax, you can now less withholding tax. You will less withholding tax. You can less withholding tax. There are some income, they are subjected to withholding tax at source. Most of the unearned income, like rent, interest, they have been subjected to withholding tax. Tax has been deducted on them at source. We less it from our personal income tax to get our net tax due. This is the annual, your net tax due is the annual tax that you will pay. If they ask you what is your monthly tax, you divide your net tax due into what? Into 12. If they ask you what is your monthly tax, this your net tax due after you have deducted withholding tax, you divide it into 12. I'm still coming to this rate. I want to ask a question, please, but you have to give me a break of 10 minutes. I have to sort an issue now, please. A break of 10 minutes.
Can hear you, sir.
Hi, we can hear you.
Okay. I said our chargeable income is 3.5 million. How do I compute the personal income tax? Your chargeable income is 3.5 million. So how do you compute your personal income tax? Oh yeah, compute it. Who can help us?
You said the first from the 3.5 million. If our chargeable income is 3, okay, do you want the final answer?
Yes, I want the final answer.
The final answer is 339,000.
Okay, explain how you get 339,000. Since you have told me the final answer.
I took 800 away because it's 800 shouldn't be charged. Then the balance
800 is charged at
0%, rather. 800 charged at 0%. Then the next 2.2 million charged at 15%, which gave rise to 330,000. Then the balance of 50,000 was charged at 18%, which gave rise to 9,000.
Okay, but I said my chargeable income is 3.5 million. So if I want to compute the tax liability, I'm coming. I want to use Excel. I want to share an Excel with you. So let me share an Excel. Can you see the Excel now? So let me calculate it for us to see. $3.5 million is the chargeable income. So first 800,000. First 800,000. That one will be charged at what? It's going to be charged at 0%. At 0%. 0%.
And 2,000.
Of 3.5. I've removed 800. Have you?
Yes,
I have removed 800 out of 3.5. How much is it remaining?
2.7.
I will remove 2.2.
2.2.
2.2. At
15%.
15%. At 15%. So 2.2. 2.2 times 15%. That one will give us 330, Abby.
Yes, sir.
So that means so far I have removed 3 million. 800 plus 2.2, Abby.
Yes, sir. Yes.
Balance is what? 500,000, Abby. That one will be taxed at what?
18%.
The next is going to be taxed at 18%. That 500,000 will be taxed at 18%. That means 500,000 times 18%. So your total tax, personal income tax, will be 0 plus 330 plus 90. Can we see that?
Yeah.
420. Can we see that? 420. 420. That will be our personal income tax on chargeable income of 3.5. That will be the personal income tax. On chargeable income of 3.5. So let's go back to the explanation. Now, the next thing we should know now is, under this format, let's go and explain earned income. Earned income under this format. Earned income. What do we understand by earned income? Earned income. Earned income simply means income derived from employment and trading activities. Income derived from employment and trading activities that involve physical and mental effort of the taxpayer. I've defined earned income. Let me show you where we define it, because we want to start explaining all those formats one by one. We cannot just jump into calculation without explaining those formats. The formats are very important. They are very, very important. So we start from explanation of earned income. Earned income means income derived from what? Employment and trading activities that involve physical and mental effort of the taxpayers. That means all those earned income, what that definition means is that you are going to put your physical efforts, your mental. You derive all those income you derive from employment, basic salary, housing allowance. Employer will not just pay you. You are using your mental and physical efforts. You will go to work. You have to go to work. You will not sit down at home. That is your physical and mental. Physical. By going to work, they have to give you some tasks for you to perform. Maybe through your laptop. You have to use your brain to write some letter now. You have to think, do research. That is mental effort. Those income that involve derived from employment and trading activities that involve physical and mental effort of the taxpayers is called earned income. You use your brain, you use your physical. Somebody doing business will not sit down at home. He will be going to his office, to his business location. He will be going to market to go and buy goods. Physical efforts. Mental effort. You'll be sitting down. How much am I going to sell the product for me to make profit? All those income derived from such activities is called what? Earned income. An example of earned income, like I explained, basic salary, housing allowance, transport allowance, leave allowance, benefit in kind, trading income, professional fee. They are all earned income. It involves physical and mental effort of the taxpayer. Income relating to an individual that derive from trade, business, profession, vocation, employment. They are earned income. Now, if we go to the format, for us to look at that earned income, this earned income in the format, some of the earned income, they are assessed to tax on preceding year basis, while some are assessed to tax on actual year basis. Let's check the format. Any income coming from employment, any income that comes from employment is going to be assessed to tax on what basis? Actual year basis. Actual year basis. Any income that is coming from employment is going to be assessed to tax on actual year basis. You can see, I color them. All this any income I mentioned, they are from employment. Oh. Basic salary is from employment. Entertainment allowance is paid by the employer. Leave allowance, staff bonus, gratuity, utility allowance, housing allowance, transport allowance, benefit in kind. They are paid by the employer. They are assessed to tax on what basis? Actual year basis. That means the earned income we derive this year is going to be assessed to tax this year. Why trading income, professional income, part-time income, other the earned income, the others, we call them trading income, such as adjusted profit less capital allowance, professional fee, part-time income, chargeable gain, all those ones, they are assessed to tax on what basis? They are assessed to tax on preceding year basis. We assess them to tax on preceding year basis. We assess them to tax on preceding year basis. So all this earned income coming from adjusted profit less capital allowance, which is total profit, or professional fee, or part-time income, or chargeable gain, all those ones that is not coming from employment, they will be assessed to tax on what basis? Preceding year basis. But any income coming from employment, is going to be assessed to tax on what basis?
Actual year basis.
Actual year basis. So this is the basic foundation of personal income tax. Basis of assessment is the basic foundation. If you don't get the basis of assessment of personal income tax right, anything you are doing is just otigos. Because in some question, examiner will give you 3 years personal income tax, 3 years employment income. They will give you employment income of 2025, 2026, 2027. They will give you trading income of 2025, 2026, 2027. They will now ask you to compute tax liability for 2027 year of assessment. Which employment income are we going to use? Which year employment income are we going to use?
2027.
2027. In the case of trading income, which year trading income are we going to use?
2026.
2026. So you must get that right. This is the main foundation of personal income tax. Basis of assessment. Earned income is divided into 2. Employment income, trading income. All the income coming from employment, we know them. Trading income, adjusted profit, less capital allowance, professional fee, part-time income, chargeable gain, capital gain. They are all trading income. All those ones, they are assessed to tax on preceding year basis. and have defined earned income to you. In relation to an individual, earned income means income derived from trade, vocation, business, employment that involve physical and mental effort of the taxpayer. Now, I want to talk more on this employment income. Employment income can be divided into two. Cash emolument. There are some employment income. Employer pay the money to you. They send the money to you. Whether they pay you by cash or send it to your bank account. We call those one cash emolument. You receive the money in form of cash or they pay it to your bank account. Why some? They are non-cash emoluments. Employee did not pay you any cash, but maybe they provide benefit to you, but it's not in form of cash. So definitely employment income under earned income is divided into two: cash emolument and benefit in kind. Cash emolument and benefit in kind. So all this one up to transport allowance, they are cash emoluments. They are what? Cash emoluments. Up to transport allowance, they are cash emoluments. They are cash emoluments. Why the second type of employment income is what? Benefit in kind. Benefit in kind. Let me go and explain them. I have explanation of them. Cash emolument, benefit in kind. Two types of employment income. Two types of income coming from employment. Cash emolument and what? Benefit in kind. Cash emolument and benefit in kind. Let me go and explain them. I have an explanation regarding them. Cash emolument, they are the remuneration an employee receives from the employer in form of cash. In cash does not mean the employer will give you cash. Oh. They can send the money to your bank account. Oh. Abi? So, who can give me an example of cash emolument? 5 examples of cash emolument.
So, salary.
5 examples
13% bonus. 13% bonus.
These people are funny. Hey,
Christmas
basic
bonus.
salary, housing
Basic
allowance,
salary, leave allowance, housing allowance, transportation
transport
allowance,
allowance,
lunch.
to etc. Staff bonus. They are cash emolument, Abi.
Yes.
Benefit in kind now. Benefit in kind. For us doing personal income tax, if you don't talk about benefit in kind, we have not done anything in personal income tax. Benefit in kind means non-financial benefit provided by an employer to the employees. Benefit in kind means what? Non-what?
Financial benefits.
Provided by who?
Employer to the employee.
To the employee.
To the employee. Another way they can define benefit in kind: expenses incurred by an employer in the provision of benefit to who?
Employee.
To the employees. Expenses incurred by an employer in the provision of benefit to who? To the employees. Some people define it as non-financial benefit received by an employee in the course of provision of service to the employer. So that is benefit in kind. You don't receive cash, you receive a benefit. Type of benefit in kind: If you look at section 14 of Nigeria Tax Act, it talk about treatment of benefit in kind. Nigeria Tax Act 2025, section 14, talk about treatment of what? Benefit in kind. How many benefit in kind do we have? What are the type of benefit in kind? Provision of accommodation, provision of other assets like motor vehicle, provision of domestic staff or support staff. Do you understand? They are benefits in kind. Provision of accommodation, provision of other assets, provision of support staff or domestic staff. Employer can give employee a car. That car given to employee is a benefit in kind. It will be added to the income of the employee. Employer can provide an employee an accommodation that will be staying. That employee, that accommodation provided by employer to the employee is a benefit in kind. It will be added to the income of the employee. Employer can give an employee a driver, a security, a gardener, a cook to be helping the employees. They are benefit in kind to the employee. It will be added to the income of the employee. Now, how do we treat benefit in kind? Based on the new tax law. Under the old tax law, the way we treat benefit in kind is different based on what is stated in section 14. This is one of the changes in personal income tax. Last year, how we treat benefit in kind under the old tax law is different based on what the new tax law is saying now. First, provision of other assets. What are the other assets provided by the employee? Car, furnitures and fitting, motor vehicle, plant and machinery. If an employer give an employee a car, how do we treat that benefit in kind? How much are we going to recognize as income to the employee? 5% of the cost of the car will be recognized as income. As long as the employee is still using that car. Every year that employee use that car, 5% of cost of acquisition of that car will be added to the income of the employee as benefit in kind in relation to car. Any other asset too provided, if it is plant and machinery, 5% of the cost. If the cost is not known, if you don't know the cost, you have to get the market value of that car. 5% of the market value will be used as part of the benefit in kind. However, if you have the cost, you have the market value, which one are you going to use to calculate your benefit in kind? You have the cost that they purchase the car. You have the market value. Which one are we going to use to compute the benefit in kind?
Use the cost.
Cost.
You use the cost. Because the market value will be higher than the cost. When they buy that car, maybe they buy it in 2021. A car that was bought in 2021 can be bought at maybe 21 million. If they want to buy it now, they can buy it 30 million because of rate of exchange. You can't use the current rate. It's only when you don't know the cost, you use the market value. Please, don't, you have to take note of that.
So does this apply to only car?
Motor, by any provision of other assets, plant and machinery, furnitures and fitting, motor vehicle, they are the provision of other assets.
Okay, 5% of it is what you take.
Yes. You add it to the income of the employee. You name it benefit in kind, either car, either plant and it depends on that benefit in kind. You put it under the earned income of the employee. You know, benefit in kind is under the earned income, have you?
Yes, sir.
Another treatment, provision of accommodation. Zoom user, you raise your hand.
Yes, sir. Regarding the 5% benefit that you said it will be added to the employee's salary, Assuming is the company that is now giving the employee fuel for the car. That is, the employee is not spending anything, the maintenance on the car, the fueling and all. Will they still give him additional 5%?
No. That is motor running expenses.
Yeah.
So that one can be treated in the expenses of the company.
Okay. Thank you, sir.
Yeah. So provision of accommodation. If an employer provide an employee accommodation, be staying in accommodation. Maybe you are staying in Ogun State and you are one of the good staff. Maybe you are one of the good staff of the company. They don't want you to stay far from the company head office. Why are you staying in Alagbole Akute? Why are you staying in Ogun State? They will now rent an apartment for you. You'll be staying. That apartment rented for you will be added to your income. How do we treat provision of accommodation? The provision of accommodation, we have to determine whether the accommodation is owned by the company or the accommodation is rented. If the accommodation is owned by the company, the annual rateable value, how much can the company rent the accommodation? That is called annual rateable value. If the company want to rent the accommodation to another person, how much will the company rent the accommodation? That will be the benefit in kind, subject that annual rateable value is not more than 20% of your gross income before 20% of your employment gross income before deduction of that, before addition of that accommodation. This place is very important. Let me explain again. Even if the accommodation is rented or is owned by the company, how much rent does the company pay? Or how much is the rateable value of the accommodation? Is what we recognize as benefit in kind to the employee, is what we added to the income of the employee. However, this is subject to what? It is subject to maximum of 20% of employment gross income before addition of that benefit in kind. Let me go to Excel and explain this. So it may not solve the question today. When we get the explanation right, we can start solving question. So explanation is very key. Look at it. Look at a question now. Let me open a sheet. Mr. Tunde has this following employment income. What is the employment income of Mr. Tunde? He has employment income of basic salary, transport, housing allowance, leave allowance, bonus. So basic salary 20 million, basic salary 20 million, transport 13 million, housing 4 million, leave 3.2 million, bonus 5.6 million. We are not told that the employer provide accommodation to the employee. And the rent paid on that accommodation, rents paid on the accommodation, the annual rent that the employer pay on that accommodation is 6 million. 6 million. The question is, how much are we going to recognize as benefit in kind? If we want to compute the personal income tax of this employee, how much are we going to recognize as benefit in kind accommodation? Is it the 6 million? We have to test. 20% of addition of, what is the addition of employment income before benefit in kind? What is the addition? This plus this plus this plus this plus this, Abby?
Yes.
Times what?
20%.
20%. Maximum of rent that they can, maximum of benefit in kind that they can put as the accommodation is 20. So how much am I going to recognize as benefit in kind? Look at the 20% now. 6 million is what I'm going to recognize. 6 million. 6 million is what I will recognize. Do you understand? 6 million is what I will recognize. But if the 20% is, maybe this one is 10 million. 10 million. This one is 3 million. 20% is less than the annual rent. How much am I going to recognize?
5,160,000.
5,160,000. Are we making sense?
Yes, sir.
5,160,000. That is what we are going to recognize.
So it's lower of the benefit in kind and the 20% of
lower of the rent amount paid.
Yes.
Or 20% of gross income before benefit in kind.
In kind, okay, sir.
Before that benefit in kind. Do you understand?
Yes, sir.
That is this treatment of this. So let's go back to the explanation. That is on benefit in kind accommodation. Provision of benefit in kind accommodation. I give example. I said the annual gross employment income is 10 million. And the annual rateable value of accommodation provided by the employer is 3 million. So the maximum accommodation benefit that they can claim will be 20% of 10 million, which is 2 million. They will not use 3 million in the employment income. They will use 2 million. I've explained that in an Excel too. Another benefit in kind we have, another type is called provision of domestic and support staff. Provision of what? Domestic and support staff. Employer can give employee a domestic and support staff like driver, security, gardener, cook, etc. How do we treat them? We treat them in two ways. Sometimes we will recognize them as benefit in kind to the employee. In another way around, we may not recognize them as benefit in kind to the employee. In the first one, if you want to recognize them as benefit in kind to the employee, that means that support staff is not a direct staff of the company. If the support staff is not direct employee of the company, the annual salary paid to the support staff will be added to the income of the employee that enjoys the support staff. But if that driver is also staff of the company, they are in the same payroll with the staff that enjoy his service. I'm the JM Finance, General Manager, Finance. They give me a driver. That driver too is a staff of my company. It's inside my payroll. It's inside the payroll of the company. The salary paid to that driver will not be added to me as benefit in kind. But if the driver is an outsourced staff, they went to one company to go and outsource a driver. It's not a permanent staff, a direct staff of the company. The salary paid to that driver will be added to the income of the employee. Are we making sense? Hello?
Yes.
Hope my explanation is clear.
Yes.
So this is the foundation of personal income tax. Before we go to calculation, we must understand the basis. For us to understand the basis. Okay, really one. What is your question?
Good morning, sir. I just want to ask, in a situation where the company sponsor an employee for traveling expenses, so are we going to treat
It's
that
not a
as
benefit in kind. It's not
okay?
a benefit in kind.
But
Traveling expenses.
but it is the employer that sponsor all the expenses.
Eh?
But it is the employer that sponsor all the expenses of the traveling
It's part
for
of
the
staff
employee.
welfare. It's not benefit in kind.
Okay.
Yes. Now,
Thank you.
the next thing we need to look at is what are the benefits in kind exempted from personal income tax? What are those benefits provided by employer? Non-financial benefits provided by the employer to the employee that will be exempted from personal income tax. What are those benefits? Number one, expenses connected to provision of meal or canteen services or provision of lunch. If an employer is giving an employee lunch every day, go and eat lunch, go and eat, they give them meal, they give them a meal ticket to eat. It's a benefit in kind, but it should not be taxed. It should not be added to the income of the employee. We can treat that as part of staff welfare so that the employee can improve better. It can lead to increase in productivities of the employee. So expenses connected to provision of meal or any other canteen services to staff is exempted from tax. So it's part of benefit in kind exempted from tax. Expenses connected in provision of uniform, they give you a uniform or overall or protective cloth, or they give you a working equipment like laptop, like phone. Employer buy you a phone, they buy you a laptop. It's not a benefit in kind though. Or they give you an official uniform wear, or they give you a protective equipment for you to be using. It's not a benefit in kind though. It's not taxable. It's not taxable. They won't say you come and pay tax on it. If my employee buy 2 million laptop for me to be using, my employer give me a 2 million laptop, they should not add it to my income. It's exempted from tax because it's an office equipment. I'm using it for office assignments. Yeah. So expenses connected with any employee change of residence. You want to change a resident. You want to move from one place to another. You are transferred from Lagos to Calabar. You need to carry some of your load. You need to move your family. You need to do some logistic. Employer provide you that. They will not add it to your income. Another one, reasonable touring expenses, reasonable touring allowance. Reasonable touring allowance. Maybe you are a marketer. You have done well for the bank, for the company. End of the year, they now give you an allowance to travel to abroad for touring expenses, for touring activities. You and your family. That one, reasonable one. It must be reasonable. It's not a benefit in kind. Example of reasonable touring, maybe end of the year, we do staff party, reasonable staff party. It's not the one that we now go and call Davido, and we call the whiskey. So, reasonable one. End of the year, some company can take their staff to some resort center for tourists. Reasonable one. Reasonable entertainment allowance too. End of the year, you give your staff some gifts, rice, beans, groundnut oil, chicken. Reasonable one. Oh. It must be reasonable. The best performing staff, maybe you buy some gift to the person. It's not taxable. So these are benefit in kind, not exempted from tax. That are exempted from tax. So we have talked about benefit in kind. Employment. You know, we are talking of earn income. Hello? Yes. What is your question?
Please, this place that is talking about has talked about it before.
What did he say? No, we said earn income as employment income, it has trading income. And we have mentioned employment income. We divide employment income into two, cash emolument and benefit in kind. We mentioned that. Those are the employment income. Now, we need to talk more on the employment income. When we talk about employment, what do we understand by employment? We need to know what is employment. Employment under section 147 of NTAA and section 201 of NTA. Employment simply means any appointment or office, whether public or otherwise, whose remuneration is payable. When you are given any appointment and every month they pay you a remuneration, they pay you a salary, that is employment. The labor law defines employment as a contractual relationship. A contractual relationship which an employee agrees to perform a work for employer under the supervision of the employer for exchange of wages. That labor law also defines employment as an agreement between an employer and employee that an employer that the employee provide certain service in return for salary paid. So, but what the tax law is saying, section 147 of NTA, define employment as any appointment, whether public office or private office, that you are being paid a remuneration. That appointment is called employment. And under the tax law, we have two types of employment: Nigeria employment and foreign employment. Nigeria employment and foreign employment. What is Nigeria employment? Nigeria employment means any employment that the duties are wholly or partially performed in Nigeria. Nigeria employment means that those employment that in which the duty are wholly or partially performed in Nigeria. That duty, that thing that they employ you for, you are performing that service in Nigeria. That employment is called Nigeria employment. But foreign employment means those employment in which the non-resident persons which hold a foreign employment perform that service partially in Nigeria. What foreign employment means is that person that is doing that service, that person is not in Nigeria, but is doing that service in Nigeria. Some people, they are paying them salary in Nigeria, but they are not physically present in Nigeria. That is foreign employment. That one too is tax. The person doing the service is not in Nigeria. He's performing the service in Nigeria. Another way, foreign employment means those employment in which the service also perform outside Nigeria. You are in Nigeria. You are performing the service outside Nigeria. That is foreign employment. Foreign employment. Now, we are still this underemployment. We need to talk more of it. Under the labor law, there are two types of employment contract. Under the labor law, there are two types of employment contracts under the labor law: contract of employment and contract for employment. Contract of employment and contract of employment. Some people call it contract of service and contract for service. One is off, another one is for. We should understand this. Contract of employment and contract of employment. Contract of employment and contract for employment. Examiner can ask us what is different between contract of employment and contract for employment. If examiner want to ask it in another way, they can ask you what is different between contract of service and contract for service. I can normally ask this question. In 1 year, I can want to ask this question. I can say, what is different between employment and profession? What is different between employment and profession? They are still asking for what is different between contract of employment and contract for employment. This contract of employment is a full-time job. You collect salary. In contract of employment, you collect salary. But in the contract for employment, that one is part-time. You don't collect salary. You earn profits. So if you are asked, what is the difference between contract of employment or contract for employment? Number one difference is an individual under contract of employment earn remuneration or earn salary. An individual under contract of employment earn salaries or earn remuneration. Why an individual under contract for employment earn what?
Profit.
Profit. Another difference is that an individual under contract of employment is assessed to tax on actual year basis. An individual under contract of employment is assessed to tax on what basis?
Actual year.
Why an individual under contract for employment is assessed to tax on what basis?
Preceding year basis.
Preceding year basis.
Another difference. An individual under contract of employment is not expected to file value-added tax return. Employee is not expected to file value-added tax return. But an individual under contract for employment is a self-employed person and is expected to file what?
VAT.
VAT. Is expected to register for VAT and file VAT return. Another difference.
Can also claim.
Hello? Okay.
He said he can also claim withholding tax.
Yes. Another difference is contract of employment is a full-time service. Why contract for employment is a what?
Part-time or a contract.
Another difference. An employee has a right to unlawful dismissal and receive redundant payments or other employment rights under contract of employment. But in the case of self-employed, when they give you a job as a part-time person, once you finish the job, that contract do what?
Ends.
End. But in the case of contract of employment, that employee, if you want to sack an employee, you have to follow what?
Process.
Labor law. You cannot just unlawfully dismiss an employee. So these are the differences. So ICAN can ask this question in another way. They can say, what is different between employment and profession? Employment means contract of employment. Why profession means what?
Contract for employment.
An individual under employment receives salary. An individual under profession receives profit and profit. You can use it in that way. Employment is assessed to tax on actual year basis. Why profession is assessed to tax on what basis?
PYB, preceding year basis.
Employment is not, an individual under employment is not expected to register for VAT, but an individual under profession is expected to register for what?
VAT.
You use it in that way. That question can be asked in 3 ways. It's the same thing they want you to say. It is now left for you, the way you fine-tune it. They can ask you contract of employment, contract for employment. 1. They can ask you contract of service, contract for service. They can ask you employment and profession. Tell us the difference. I can also set it up again. What is different between full-time job, full-time employment, and part-time employment? They can ask it that way.
It's still the same thing.
Don't you know? So hope my explanation is clear.
Yes, sir. Thank you.
So we are under earned income. Oh. We are explaining all what we are doing before since morning. We are explaining employment income, employment income, employment income, under earned income. We have explained them. So which one is left there? Another thing we need to know is under this employment income, there's another thing that we need to know. In the case of compensation for loss of office or for loss of employment or for loss of for injury suffer, when an employee is given a compensation for loss of office or for loss of employment or for injury suffer, how do we treat that compensation? Section 50 of NTA said if an employee receives a compensation for loss of office or loss of employment or injury suffer, if that compensation is not more than 50 million, that compensation will be exempted from tax. But if the compensation is more than 50 million, the excess of that amount will be subjected to company income tax. Let me repeat again. Section 50 of NTA said when an employee, an individual under employment receive a compensation either for loss of office or for loss of employment or for injury suffer, person is working in a factory, is a factory worker, he now put his hand in one of the equipment. Before we know, handicap. Insurance company now say, the company now insured the company have insured the staff working in the factory. If the insurance company pay that person a compensation, if the insurance person pay the person a compensation, how do we know that that compensation will be taxed or it will not be taxed? There are two ways. First, if the compensation is not more than 50 million, it will not be taxed. But if the compensation is more than 50 million, the excess of that compensation will be taxed. They want to reform your office. You have spent 15 years in that office and they need a fresh brain, young graduate who have a fresh brain. Oga, you start going home. Start going home. But before you go home, you have to give you some compensation so that you go and find something to do. Maybe you can go to your village to go and start farming. That is compensation for loss of office. If that amount is not more than 50 million, it will not be taxed. But if it is more than 50 million, the excess of it is going to be taxed. Are we making sense? Are we making sense?
Yes.
So these are now the next thing we need to look at. Income exempted from personal income tax. What are the income exempted from personal income tax? What are the income that if an employee earn or an individual earn, it will not be subjected to personal income tax? All BIK exempted from tax. All BIK exempted from tax. What are the BIK exempted from tax? All BIK exempted from tax. What are the BIK exempted from tax? What are the benefits in kind exempted from tax?
Provision for accommodation.
Lunch voucher.
No. Provision of lunch voucher, provision of uniform or office equipment, relocation expenses, entertainment, reasonable touring allowance. Another one, another personal income tax exempted from tax. Reimbursable expenses incurred by an employee in the course of provision of service to the employer. You spend your money to transport yourself to Port Harcourt to provide service. After you finish that doing that job,
Good morning.
company pay you the money
So,
back.
from the
That
previous
is
experiences
reimbursable expenses.
with Mangala, how many can a carton on the carry? And then
Please
can you
mute your
buy
audio. Mute your
them
audio,
just
madam.
the
Choma,
cartons?
Choma.
Sorry, I forgot that.
Okay. Another personal income tax exempted from tax. Compensation for injury suffered in the course of employment. This one must not more than 50 million. It's exempted from tax. Dividend too. Dividend is a frank investment income. It's exempted from tax. Interest from federal government security, long-term security. If you receive interest from bonds, you receive interest from government stock, it's not taxable. Profits on sale of fixed asset too is exempted from personal income tax. All these are the income exempted from tax, personal income tax. So they are the income exempted from personal income tax. Evelyn, you can ask your question.
Okay, sir. Sir, please, can you take it to that income exempted from personal income tax? There's one line I need you to explain, please, sir.
Okay. Which line?
Where it talks about interest credited on a deposit, interest credited on deposits of less than 50,000 or something like that. Income exempted from personal income tax. Yes, this Roman figure 4 that says interest credited on deposit of less than 50,000 naira balance. I want you to explain that part.
That one is taxable now. You know, this material, I'm still working on it. I will adjust it. It's now taxable. Do you understand? It's taxable. Any interest you receive on your savings account is taxable. They deduct withholding tax on it. Even if that deposit is 1,000 naira, they deduct withholding tax. Please ignore this.
Okay.
Yes. I will still send you the updated material. That is the reason why I don't want to send this material. So let's go to that format again. Let's go to the format again. Let's go to the format again. For the format, on earned income, what is on earned income? On earned income means income derived from investments. Income derived from what? Investments. They are the unearned income. The income you derive from investment, they are called what? Unearned income. When you derive an income from investment, such income is called unearned income. And unearned income is assessed to tax on preceding year basis, PYB. Example of unearned income: rent. If you receive a rent from your properties, it's an unearned income. If you receive a interest from your savings account, it's an unearned income. Another unique thing about unearned income is unearned income normally attract withholding tax. Unearned income, they normally attract what? withholding tax. Before you receive an unearned income, they will deduct withholding tax from that unearned income. Take for instance, a company rent a property. The annual rent of that property is 20 million. If a company want to pay the rent to the landlord, the law say the company should deduct withholding tax of 10%. 10% of 20 million. That is 2 million. Company should not pay 20 million to the landlord. They should pay 18 million. The balance of that 2 million is withholding tax. They will go and remit it to tax authority. In the name of the landlord. In the name of who? The landlord. Because the landlord is still going to use that 2 million to offset his final tax liability. The landlord will still use that 2 million to offset his what? Final tax liability. Interest. You give out a loan or you receive you invest your fund. You are now giving interest. If they want to pay you interest of 5 million, they will not pay you 5 million. They will deduct withholding tax of 10%. 10% of 5 million, 500,000. They will pay you 4.5. That 500,000, they will go and remit it to tax authority. And that 500,000, why they remit it to tax authority, they will remit it in your name. The owner of that income, they will remit it in the name of the person that owns the income. So that if the person that owns the income wants to compute his final tax liability, it will use it to offset his tax. If you look at it, after our final tax liability, I say less withholding tax. That means less withholding tax that have been deducted on rent. Less withholding tax that have been deducted on interest. We less it from our tax liability. It is the balance we pay. Do we understand that? Do we understand? In an exam, examiner can give you an earned income in gross. They can give you in net. They can give you in what? Gross or net. If they give you in net, what do you supposed to do?
You gross it up.
You convert it to gross.
Yes.
Why you want to solve the question? You must use gross. If the examiner give you net, the right rent net, that means after they have deducted withholding tax, the balance is that net amount. But gross, the amount before they deduct withholding tax, that is gross. Net, the amount before they deduct withholding tax, after they deduct withholding tax. If examiner give you net, it is your responsibility to convert it to what? Gross. So please take note of that. It is your responsibility to convert it to gross. Let me do example in an Excel for us to understand. Let me do example in an Excel for us to understand. A rent, Mr. Tunde receive a net rent of 4 million from his properties. From his properties. So I receive a net rent of, Mr. Tunde receive a Mr. Tunde receive a net rent of 4 million from his property. Net 4 million. How can I get the gross amount? Who can tell me? How can I get the gross amount?
You divide 4 million by 90%.
Because first, gross. What is the percentage of gross? Gross percentage is 100. Abi?
Yes, sir.
Withholding tax percentage is what?
10%.
10%. Abi?
No.
That means net percentage will be what?
90.
90.
90. So I was given net 90. I'm asked to get 100. So 100 all over 90. That is what I would do. 100 all over 90. Times 4 million. $100 all over 90 times 4 million. 100 divided by 90 times 4 million. Okay, let me use, instead of 4 million, 10%. Let me use 4.5 so that we can get a round figure. 4.5. A net rent of 4.5. So 100 divided by 90 times 4.5. What are we going to get?
5
5
million.
million.
5 million. So if you want to solve a question, if you want to disclose the income of Mr. Tunde, how much are we going to say Mr. Tunde earn?
5
5
million.
million. Though he received 4.5 million, Abi? So the difference between that 5 million and 4.5 is the withholding tax, and he's going to use it to offset his final tax liability. So Evelyn, what is your question? Evelyn, you asked a question. What is your question? Hello? Okay, we can proceed. Do we understand?
Yes, sir.
So,
Mr. Idris, my hand has been up.
okay, what is your question?
Please, I want to know, this 10%, is it from the question or is it the approved withholding tax rate?
Approved withholding tax rates.
By
Approved withholding tax rates.
by this new tax law?
By withholding tax regulation 2024. We have a withholding tax regulation 2024 that started 1st of January 2025.
Okay.
Withholding tax is not in the new tax law, it's a regulation. It's not in the new tax law. So the regulation we are using on the withholding tax, the latest regulation we are using was drafted in 2024 and it commenced in 2025. That is what we are still using till now. And they have rates. Different income have their own rates.
Okay.
Yes. My colleague is still going to take you a topic called withholding tax, where you will see different rate of withholding tax.
Okay, sir. So this 10% is peculiar to rent?
Yes.
Okay, sir. Okay.
So that is on an earned income. we should know on earned income is assessed to tax on preceding year basis. So we should know that. Let's look at filing of return by employee and employer. Filing of return by employees and employers under personal income tax. Filing of return by employee and employer under personal income tax. First, employee returns under section 13 of NTAA. A return of income shall be filed in prescribed form with the relevant tax authority in each year of assessment by every taxable person, whether or not liable to tax in Nigeria, and non-resident person liable to tax in Nigeria. The return is required to be filed in this section shall contain duly completed self-assessment form, the amount of income from each source, personal relief, and tax computation. In the case of employment, in the case of income earned from trading, audited financial statements, and evidence of tax payments. There are two types of return filed. First return is the return filed by the employee by themselves. That one is called self-assessment return, direct assessment return under section 13 of NTAA. What is the timeline for filing this return? By either you are an employee or you are a trader, you must file this return by yourself. What is the timeline? You can tell me. I'm ready to give a way price. This return under section 13 of NTAA, filed by employee by themselves under the personal income tax. What is the timeline for filing it?
6 months.
31st of March every year or every following year. 31st of March every following year. Under the new tax law, before, it is only self-employed person that file direct assessment return, 31st of March. But in the new tax law, this section 13 now said it is not only those who are doing business, even an employee too. Somebody in an employee is now liable to file direct assessment return by 31st of March, where it's going to show his employment income. Should in case that employee have a secondary income or any other income, it's going to indicate it. That return filed by 31st of March by every taxable person, either individual, either employee, either a trader, either a resident individual, is that employee return stated in the section 13 of NTA. I don't know whether this year you will be hearing some news that everybody should file a return in that 31st of March. Even some tax authority, they even misinterpret the law. You know how the tax authority misinterpret the law. They are now writing letter to company that they should go and file their individual employee return. Is it the company that will file that or the employee by themselves? It is the employee.
It's the employee that will file the
Nothing
return.
concerning the company. If you don't file your individual return, company will not be penalized. Tax authority will hold you, individual employee, responsible. Lagos State tries writing some letter. It's some people that now to caution them that don't write this letter. Don't misinterpret this law. The one that the employer must file on behalf of employee is the annual return filed by 31st of January every year. Abi? Annual return filed by 31st of January every year is the one that government can hold employer responsible. That one is stated in what section of the Act? Section 14 of NTA. We call that one employer return under personal income tax. All your employer together, you add their salary, you add the tax you have deduct, the personal income tax you have deduct from them. You file it 31st of January every year. This one is what government can hold employer responsible for. Do you understand? But in the case of individual return filed by the employee or filed by the individual, government cannot hold company responsible for it. If I don't file my individual return, government cannot say my company will be penalized because it's my own personal issue. My company does not know my secondary source of income apart from employment income. Abi? The work I'm doing today, Saturday, Sunday, does my company know the income? No. So it's me, individual, that is responsible to file that. So when we talk about filing of return under personal income tax in respect of employment, in respect of employee and employers, there are two returns. First, return filed by employee by themselves, individual return, stated in section 13 of NTAA. That one must be filed on or before what? (31st of March every following year). Second one, the return filed by the employer on behalf of employee, annual return filed by the employer on behalf of employee. That one must be filed on or before what?
January.
31st of January every following year. Hello, hope this explanation is clear.
Yes, sir.
They can ask you, what are the content of individual return filed by the employee? What are the content of individual return filed by the employee? Content of individual return filed by the employee. What are the contents? I've stated here. Duly completed self-assessment form. Amount of income from every source for preceding year of assessment. Personal relief and tax computation. In the case of income earned from trading, audited financial statements, and evidence of payment of tax due. That is the reason why employer, what employer do this year is by ensuring that every employer, they give what employer do this year is they give every employee their taxpayer ID. And they ask them to go and log in into their e-tax. Me now, I have my taxpayer ID. I can log into my e-tax to know every tax paid by my employer in my name. And that e-tax, I can use it to file my individual return by 31st of March. I've done that in before 31st of March. So please, let's take note of that. Section 15 of NTA said all these return, either employer return or employee return, filed in respect of personal income tax. The tax authority should design a process that will simplify that return. Tax authority should issue out a guideline for filing that return so that that return should be simplified, should be simple, so that even somebody that don't go to school can file that return by themselves. Simple way, simple format. Give out a guideline for filing the return so that the return can be a simplified income tax return. I should not be paying tax. I now be saying, since I'm not a tax person, maybe I'm a business person, the format you want me to file in this return should be easy to understand. Simplicity. That is what section 15 of NTAA is talking about. Are we making sense? So, another thing we need to explain. What are the offenses and penalties under personal income tax? What are the offenses and penalties under personal income tax? One of the offenses and penalties under personal income tax is failure of individual to register for personal income tax. When you fail to register for personal income tax, that means you fail to have taxpayer ID. Failure to register. A taxable person, an individual or a trader, fail to have a taxpayer ID. What is the penalties? 50,000 in the first month of failure under section 100 of NTAA. 50,000 in the first month of failure. Why 25,000 for each subsequent month in which the failure continued? Apart from that, an administrative penalty can be awarded to the company. Another offense is when a company award a contract to an individual that don't have a taxpayer ID, unregistered person. You as a company, you award a contract to unregistered company, unregistered person, somebody that don't have a tax ID. You give out a contract to the person. What is the penalty that company will pay? The company will pay administrative penalties of how much?
50,000.
Administrative penalties
5
of how
million.
much? 5 million.
5 million.
5 million. Administrative penalties of 5 million. Another penalty, failure to file return. When you fail to file personal income tax return. You fail to file personal income tax return. Maybe you fail to file that 31st of March personal income tax return as an individual or as an employee. What is the penalties? 100,000 in the first month of failure. Why 50,000 for subsequent months, as stated in section 101 of NTAA. Another one, failure to keep proper book of account. When a company fail to keep proper book of account in respect of personal income tax deducted from employee salary, that company will be liable to a penalties of 10,000. If it is a person. In the case of company, 50,000. When you as an individual, you fail to keep proper book of account of your income. You don't have your income report. What is the penalty you pay? 10,000. But if it is a company, they don't have proper record of their personal income tax deducted from employee salary, they will pay a penalty of 50,000. So, ladies and gentlemen, this is where we are going to stop today. By next week, we will start a question. By next week, we are going to start a question. Personal income tax carry 20% of our syllabus. Last year, last diet, ICAN did not set question on personal income tax. I know the reason. Because the reason is last diet's question was based on old tax law. ICAN don't want to create confusion. They don't want to set question in 2026 as regard to personal income tax that will be based on old tax law. If some people now see it, they will say ICAN is still using old tax law in 2026. So ICAN has to dodge that bullet. So they did not set anything on personal income tax. So this diet, what is 20%? We should be expecting question on personal income tax. There's no how we will miss it in this diet. So thank you for having me. I'm going to stop here. Any question?
Yes, it is. Good morning, sir. Please, I want to know the benefits of tax file return. I mean, tax return, yeah, to the taxpayer. That's all we are.
I can't hear you. I can't hear you. Your voice is too low.
Can you hear me now?
Whether you can send it the chat box now.
Okay,
Please
okay.
send your question in the chat box. Shioma, what is your question?
Please, Mr. Idris, thank you for this wonderful lecture. I want to know if they're asking us to answer questions in ICAN for this tax, are we going to be quoting the laws?
You don't need to quote the law. Don't quote the law.
Thank you,
Don't
sir.
quote the law. Please. ICAN don't ask you to quote the law. You cannot quote the law in ICAN question. You don't need to quote the law. Yes.
Like this section, that.
No. You
Thank
don't need
you
to
so
quote
much,
it.
sir.
You
God
don't need
bless
to
you,
quote
sir.
it. Yes. So any other question?
Sir, please, is your class now 9 to 11 or C8?
My class is not 9 to 11. So please, I got home yesterday very late, and I have to do some research on advanced taxation. I have to do some note on that. So I slept by 4. So for me to wake up around 8:20, since 12 o'clock, I did not sleep. I have to sleep by 4 a.m. So we are human beings. So I wake up around 8:30 something. So that is the reason why there is a delay in today's lecture. So our class still remain 8 o'clock. So any other question?
So I think Mr. Rilwan's question is there.
Should I come back?
He said, what's the benefit of filing tax return, something like that?
To the taxpayer. What is the
Yes.
benefit of filing tax return to the taxpayer? Yes,
Yes, I guess that's
yeah. If you want to collect a contract from government, they will ask you for your evidence of tax payment as a good taxpayer. You want to obtain a loan for government. If you don't pay tax, you cannot obtain a loan. In some states, if they want to give you approval to build a building plan, you want to start construction. If you don't have your evidence of filing your tax, they will not give you that plan. Mr. Rilwan, you may want to go for election position. Election is coming next year now. Maybe you want to go for House of Rep. INEC will ask you to submit evidence of your tax payment, evidence of your tax return. Mr. Rilwan, you want to go to First Bank to go and do a transaction with them. They will ask you, are you a good taxpayer? First Bank cannot deal with you if you are not a good taxpayer.
Okay, sir. Thank you.
So hope your question has been answered.
Yes, sir. Thank you.
So any other one? So in the absence of no one, thank you for having me. So during the week, by Wednesday or Tuesday, the final material will be out. Please don't let us be rushed. Send the material. We are in the new tax law. Tax is not a financial management. Tax is not a performance management where we have a standard costing, the same pattern. Tax is dynamic. The way we do tax last year, the way we compute personal income tax last year, it has changed this year. You have to do research. Tax is not static. It's different from what is break-even point. The same pattern from 5 years ago. So you can have material on that. I'm not disputing, I'm not claiming inferiority something. I'm just using as an example. For you to get a tax on material, you have to get updated material based on the new tax law. I cannot send something that is now outdated or quoting the old tax law. It will create confusion. So thank you for having me. By next
Thank
week,
you,
we meet.
sir.